Hello everyone, thank you very much for watching. Today I'd like to share with all of us something that I seldom share with people outside of Provident. You see, back in 2003, when we first started giving advice to our clients, the investment philosophy that we adopted was actually quite different from what we practice today. After we have created portfolios for our clients, allocating their monies to different asset classes such as equities, bonds, so on and so forth, from time to time, we might shift from equities to bonds or bonds to equities or to other asset classes based on our chief investment strategies, market outlook. Also, in executing the asset allocation, we use actively managed funds. Those funds whereby the fund manager, based on their prediction, will move from one asset class to another. Well, everything worked well until the global financial crisis of 2008. That strategy failed us badly. You see, the GFC of 2008 was one of the worst crises in our generation and perhaps the second worst crisis over the last century, just after the Great Depression. I can't fully describe the feeling of how it felt going through the GFC of 2008 because only those who have really managed monies and who have advised clients will understand that feeling. Every morning when you wake up to very bad news, you wake up to markets going down, you wake up to financial institutions potentially going bankrupt, and even some European countries almost unable to repay their debts. It was a very scary time, not just for the clients, but for us. To try to time the market, to try to guess where the markets they are going to go at that time is just crazy. Almost impossible to get it right. And to make it worse, even if you decide to stay invested, the funds that you invest in, the fund managers, they might not stay invested. They might move their money to cash already because they are also afraid. And for us, to make matters worse, one of the bonds started behaving very weirdly because the bonds were supposed to stabilize the portfolio, but it didn't. And to our horror, when we asked the fund manager to give us a list of the securities that they invested in, we found out that although it was a global bond fund, they invested a lot into emerging market debt, and that caused the price, the performance of the bond funds to be very bad. In the end, we have to sell off that bond fund, and that bond fund actually closed down. After the GFC, we told ourselves that we will never ever let this thing happen again to us and to our clients. 3 lessons we learned. Firstly, to try to time the market, to try to guess where the market is going to go, to try to decide whether it's better to invest in equities or bonds is just a futile attempt. Secondly, we are not going to take fund managers' risk, especially for those managers who try to predict where the markets are going, and the cost is very high. And thirdly, is that there is a great need to coach our clients to help them stay invested through a very bad crisis. After 20 years of being in this industry, we know what works and we now know what doesn't work. And that is why today at Provident, our investment philosophy is one whereby we stay invested regardless of market situation. It is a strategy that has been proven through scores of evidence that it works. And the instrument that we use those instruments that do not predict where the markets are going, and particularly instruments that are very low in cost. We only use 2 instruments, Vanguard, Dimensional. And the third thing that we do today is that we spend a lot of time before even a crisis happens to risk coach our clients. We believe that through this, clients will have a better chance of a successful investment experience. If you want to find out more about how you can invest through Provident, please do contact us. Thank you very much once again for watching this video.